Hello, investors and future investors. Welcome to the channel. For today's video, I'm going to show you an option strategy that can be used if you're trading with a small account. Now, if you're new to options trading or you're trying to use options trading to assist with your regular 9 to 5 with some extra money, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to show you how to utilize the long call in order for you to make income using a small account portfolio. I'm going to show you how to buy long calls, how to profit with the long calls, and how to manage a long calls if it decide to go against you. So, let's go ahead and get down and dirty with options. Now for today's video, we're going to be using none other than NVIDIA, ticker NVDA. So let's get started like we usually do by going to trade NVIDIA options down to the bottom in order for us to open up the option chain. Now, for those of you that are new to options trading or you're new to my channel, then this area down here is known as the option chain. The purpose of the option chain is that it gives us enough information in order for us to make a very informed decision. Now, before we go ahead and demonstrate this, I want you guys to do yourself two favors. Favor number one, always make sure to do your own due diligence before investing. And favor number two, always make sure to have an exit strategy before entering any option trade. That being said, let's go ahead and get right into this trade. Now, with the long call, to get it started, you must first go to buy and then you go to call. Now you need to choose an expiration date. The whole purpose of this option strategy is a long call, means you have to go to a long out expiration date. Just for the purposes of this video, we're going to be using October 17th, which gives us about roughly around 6 months. Now, our current strike price is at $96.40. Usually, I would choose my strike price way below this, around a 75% chance or lower. However, you always need to know what market conditions you're trading under, and you always need to use what the market gives you. That being said, I would be going with the $95 strike price. As you can see, strike price to the top here. Now, with the $95 strike price, I have a delta of 0.62. When doing long call option strategy, the delta is of extreme importance, and I'm going to show you that as the video goes along. Now, because this is a buying option strategy, we're going to have to pay. The amount we're going to have to pay is going to be $19.25. That's how it's going to be in the option world. However, in the real world, this is going to equate to be $1,925. And that is because each option contract contains 100 shares. So by simply multiplying 19.25 by 100, you're going to be getting $925. Let's go ahead and click into it. So as you can see to the top here, a long call. Now, the long call is not to be mistaken with another option strategy, which is the leaps option strategy. The leaps option strategy is a variation of a long call. So please do not confuse the two. Okay, now, how does the long call work out? So with your $95 strike price here, you have what's known as a break even. Your break even here is $113. Now, the break even tells you that at expiration date or close to expiration date, this share price right here needs to be at this price in order for you to break even, meaning in order for you to not lose any money. So if we were to go to the chart right here to the right, you could see the break even right up here, 114. Good. Now, the break even is determined by two factors. The break even is always determined by the strike price you choose plus the amount you paid for it. So by simply adding 95 and you add 19, you should get around $113, $114. That is the basis of the break even. Now, here's additional key factors for you to consider before purchasing long calls. And we will get into how you're going to use these long calls in order for you to make income. Now, I did mention that the delta is of key importance. And here is one way the delta is really, really important. The delta here says 0.62. So what that tells you is that any price movement in this price right here, upwards of $1 or downwards of $1, is gonna increase your entire options contract by the delta or 0.62. And let me go and break this down for you in simple terms. If this share price goes from 96 to 97, then this here 19.25 is gonna go up by 19.25 plus 0.62. And if the share price goes from 96 to 95, which is $1, then your option value right here is going to be 19.25 minus 0.62. So that's one importance of your delta. Now, your implied volatility. Your implied volatility here is 60%. And in my personal opinion, that is like perfect right there. The reason for that is that when you're dealing with options, you need some type of implied volatility in order for you to make some kind of movement in the stock price. Now, any implied volatility of 1% to 50% is extremely low risk. The share price is not going to fluctuate up and down very drastically. Now, if you have an implied volatility of 50% to 100%, then the share price is going to fluctuate up or down in a very medium risk territory. Now, extending to that, if the implied volatility is 100% and above, then that is very risky territory. And with those kind of stocks, the share price is going to be fluctuating extremely, extremely fast over time. Now, stocks with high volatility can still be traded. You just need to monitor them a bit more than stocks with like medium volatility. One more thing I want to bring to your attention is the open interest right here. So the open interest right here is 4,659. So there's this amount of contracts that's open. That also tells you that there's 4,659 people that think Nvidia at the $95 call expiring October 17th is worth this price of 19.25. Now, I did mention I usually do not select my strike prices this close to the share price. However, this is a bear market, so I can take that risk. Now, let me go ahead and show you one more thing. So, before the bear market, most people thought that this was the perfect strike price and Nvidia would not be going below this. And you can see that by going into the Greeks once again. The open interest here is almost 12,000. So, 12,000 people are thinking this strike price right here of $100 expiring October 17th is very good value for $16.50. So, in my honest opinion, either of these could be used, the 95 or the 100. Now, the $95 strike price and the $100 strike price is what's known at the money. At the money means the closest strike prices to the share price. So these two are at the money. Okay, now that you have a long call in your portfolio, what are you going to go ahead and do with it? Well, you're going to go ahead and do nothing. The whole purpose of buying a long call is that you're of the mindset that the share price of the stock you chose is going to appreciate in value before your expiration date. Remember, the most important factor in options trading is going to be the time factor. Every single option trader always selects the right price. We always select the right premium. We always select the amount we want to pay for it. Now, what most of us get wrong is always the strike date, the amount of time we give ourselves in order for our strategy to materialize. So, one option you could do, like I said, is to do nothing. You wait until the share price goes up. As the share price goes up, then your option value is going to go up, and that is how you make profit using a long call. Now, that's just one option. Here's another option that you can do. So, while you have your long call in your portfolio, remember this is not a trade that needs to be managed consistently. You could go ahead and get stuff done. You don't need to monitor your computer. Now, you do need to make sure you check back within 3 months. Whenever a long call goes to 90 days before expiration, then theta or time starts working against you. It starts chipping away at your options value. So let's say come 90 days to expiration and your long call, Nvidia is now trading at $115. Well, it's above your break-even price of 113 and it's 90 days to expiration. So you should be up a lot. Now, that is the power of the long call. Now, I'm going to give you another option that can be done if you have the long call option strategy. So, the first one I showed you is that once you have a long call, you could do nothing. You simply wait until the share price appreciates, and then you go ahead and you lock off your gains. The other option you have, you manage your trade 90 days before expiration, because at the 90-day mark, that is when time is going to start eating away at your option value. Now, whatever price the option is trading at, you simply minus the share price where you bought it at from the current price it's trading at, and that's going to be your gross. You multiply your gross by your delta, and that's going to be your gains. Of course, you do not need to do any of these calculations. Robinhood is actually going to show you to you in your once you open up your options contract. Now, the third thing you could do, let's say you have this leaps option and you're waiting for price value to appreciate, then you could go ahead and make some additional income. The way you can make the additional income is by going ahead and sell covered calls against your long call. And let me show you really quickly how that's done. So assuming we have this long call in our portfolio, and remember, we said our break even is 113. Now we're going to go ahead and sell covered calls in order to make consistent income. Now for that, we're going to be choosing a closer strike date. Let's go with April 17th. That gives us about 8 days to expiration. Now we're going to go ahead and we're going to choose our strike price. Remember, our break even was 113, so we need to choose a strike price, anything above that or close to it. So we will be going with the $114 strike price right here. Let's go ahead and we select that. Now, this now is selling a covered call against your long call. Now, the first thing you need to get right, always make sure you know what your break even is. You choose a strike price above your break even, number one. The next thing you need to get right, make sure it gives you a very high chance of profitability. In this case, a 92% chance of profitability. The reason why you want a very high chance of profitability is that you have a very high chance that the trade goes in your favor, because the initial concept of having a long call is to wait until the share price appreciates. That is where you're going to make the majority of your investment gains. Now, with the $114 strike price and such a high chance of profitability, you're also going to be paid. The amount you're going to be paid is going to be 0.49 here, or once again, that's going to be $49 because you multiply this by 100 shares. So while you wait for your long call to appreciate in value, there is nothing wrong with making some extra income. Remember, do not get greedy. Always make sure to stick to a very high chance of profitability. The lower chance of profitability you go, or the lower chance of profitability you have, it increases the odds of you being assigned. Being assigned simply means that your long call is simply going to be called against you. Means you're going to be forced to close it out and you're no longer going to have it in your portfolio. So let's go ahead and go back to our original long call. I'm going to show you how to manage this long call. Okay, so here we are back on our long call. And what I showed you so far is just gold. I show you how to just keep making money with a long call. Now I'm going to show you how to manage this trade if it goes against you, because every coin does have two sides. So let's say the share price of this keeps going down and now your whole options is losing value. Well, this is one thing you could do. You could simply do what we call in options, which is going to be rolling. So assume we have that contract, that long call in your portfolio, and the share price keeps going below 95. So now you look like you're in a deep doo-doo. So here's what you're going to do. You're going to simply look for your long call. You're going to go and you're going to sell it. Remember, you bought it in order to get into the contract. So now you do the opposite. So you're going to sell the call. And then once you select that, simultaneously, you're going to go ahead and buy another call. So you select it right here. Remember the $95 strike price. Now we're going to go ahead and buy another call simultaneously. Let's just use the 100 strike price. Just an example. Remember, these are not real trades. And then that's it. That's called rolling. Please ignore this here. This is not a call credit spread. We're assuming we're doing this based on us having a long call in our portfolio. Now, when you roll this option, because of where the market is right now, you will be receiving a credit. Sometimes you receive a credit, sometimes you have to pay a little extra. But the reason why I show you that is because if the share price of any stock you're trying to use for a long call goes against you, remember, do not panic. You do have options to extend the trade. You do have options to make additional income. Now, that right there, investors and future investors, is the long call option strategy for small accounts. The reason why anyone would want to use a long call option strategy, it allows you to control 100 shares of the stock price at a much lesser price than what the current share price is. So, for instance, sticking with our NVIDIA example, if you were to buy 100 shares of NVIDIA right now, it would cost you $95 per share, or it was going to cost you $9,500. If you were to use the long call option strategy, then it would cost you $19.25 or $1,925, which is a significantly less than the current share price. Now, do you guys use the long call option strategy in your portfolio? Please let me know in the comments below. Also, if you have any questions about the long call option strategy, how to use this option strategy in order to make consistent income, or how to profit from this strategy, then let me know in the comments below. So, right before you go ahead, like the video, subscribe to the channel. But most importantly, if there's anyone out there that's struggling to grow a small options portfolio, then feel free to share this video with them. Let's try to help as many as we can. And until the next video, keep pushing your investments.